What's going on, everybody? Welcome to the next video in the series where today we are talking about buy and hold. Now, if this is your first video that you're watching, please go back and start at the beginning because this is the one where you are either going to really agree with me or I might unfortunately piss you off. That is not my intent, but I do have some bold opinions and I will talk about them today. But without further ado, keeping the same theme in presentations, we're going to start off today by asking what is buy and hold. Buy and hold is a real estate investing strategy that can, I should have put an asterisk, create passive income, but it also builds long-term wealth through appreciation. Now, this is my first opinion. I'm going to jump right into it right on the first slide. This can be used for a tax purpose too. There's a strategy called cost segregation studies, which you could do as a full-time real estate professional. Pause, I'll just put here, disclaimer, I'm not a CPA, I'm not a financial advisor, I'm not an accountant. Make sure you consult your financial staff or whatever you want to call them. With that said, this is a strategy a lot of real estate investors do to offset their taxable income, so they pay pretty much dang close to $0 out of pocket every year in taxes. That is why people buy and hold properties. And with that said, one of my bold opinions is that you should not be buying and holding any real estate unless you are making at least $250,000 a year. I know, it's crazy. A couple things. One, that's technically the amount that most people are labeled as accredited investors is $250,000 a year. But more realistically, unless you're making that kind of money, you don't need to worry about offsetting taxes. With all respect, you need to worry about making more money. And so if we need to worry about making more money, active income equals acquisitions, we should go back and watch the other few videos in this series before jumping into the buy and hold category, where there's a lot more risk than there potentially could be reward depending on when you're watching this video. So just to recap, acquisition gets you in the door, exit strategy is how you get paid. And in this case, exit strategy is monthly cash flow from the asset or property you purchased in a monthly or sometimes yearly, usually monthly case. So talking about what a successful buy and hold actually is, you are buying a property below market value with enough room for cash flow and equity. Again, bold take, but what I believe is that if you're purchasing a property and you're buying it at retail or above market value, you are not a good investor. We buy properties that are at a discount, and we are using that strategy to ideally create cash flow as a long-term hold of an asset. With that said, there is a strategy where you can renovate this strategically to increase value and then attract quality tenants. This is known as like the BRRRR method: buy, renovate, rent, refinance, repeat. This is where you purchase a property and you increase its value to be able to refinance into a loan, and then hopefully you're out of pocket zero, or at worst case, trap a little bit of money in the deal so that your cash flow exceeds what your ideal return on investment numbers are. Or you could buy turnkey rentals at a discount and make sure they cash flow. That is the route I typically like to go. The reason being is that the BRRRR method is extremely difficult and it's not that common to find nowadays. It's more often in like the Midwest or the Southeast part of the country where there's a little bit of just cheaper price points and it's easier to do. When you're looking at some of the major metros, the numbers typically just don't pencil out for a BRRRR deal unless you're able to get it substantially lower than what most investors do. The next step is that you build wealth through cash flow, appreciation, the loan or mortgage being paid down by the tenants, and then the tax advantages with it. Keep in mind your wealth is built when you buy, not when you sell, okay? And I know this is talking about buy and hold, long-term holding of properties. At a certain point, you obviously offset them or you just keep rolling them into 1031s. So I understand it's not typically selling here, but you're still going to make your money or your monthly cash flow off of the purchase, not from the sell or from holding the property. The better the deal, the greater your long-term returns. And then finding great deals is the number one skill every successful investor must master. So that's why I'm very adamant about this. That's actually the whole reason we put together this series on YouTube, was that I believe acquisitions is not talked about enough. Way too often I'm seeing people talk about how you have to wholesale, you have to fix and flip, you have to buy and hold. And have you thought about private lending or development or creative finance or co-living or all of these different strategies, which, don't get me wrong, they all work. The reality is you need to get better at acquisitions and finding better deals, and then usually the deal plays out how it's supposed to. Meaning if it's discounted enough and you're comfortable flipping it or keeping it, congrats, do it. Hopefully you're making enough money and you have the risk tolerance to be able to handle it. Or worst case, you end up wholesaling or wholetailing the deal where you could go and make some fast cash and even get some deals back and money back in your pocket as fast as possible. So essentially, what did I just say in a summary? You're taking a property with potential and turning it into a cash flowing asset that tenants are willing to call home. Your job is to create long-term wealth, not just a one-time payday. Please do not look at buy and hold as a strategy to pay you quick. Don't look at this as something that is just a one-time deal. This is someone else's home that they will live in. Even if you own the property, they are renting it from you. Now there's 2 pages of key terms. There's a lot. I was trying my best to keep it short, and every time I tried shortening it to one slide, it just didn't really do justice. So key terms, ARV, again, after repair value, what the house is worth after it's renovated, especially for anything that is value add, adding square footage, renovating the property, or again, those BRRRR properties, because you need to renovate it to increase its value. So when you refinance, you get more back. Cash flow, the amount of money you're making every single month. Cap rate, which is the capitalization rate. This is how a lot of investors run their numbers to determine if it's a good deal or not. Cash on cash return is another strategy and approach that investors use to determine the return on investment. DSCR, otherwise debt service coverage ratio. Debt to income ratio, the DTI, if you're financing this conventionally, is how you get approved. Debt service cover ratio, I think we just did that one twice. Most definitely did. I apologize. Occupancy and vacancy rate. You need to know what it's going to cost you to operate a home if it is occupied versus vacant. And obviously when it's vacant, there's costs that are incurred, but then you're not making money. So you need to factor that in. Any operating expenses. I'll also give like a special honorable mention to a pro forma. This is where you could typically see all the expenses and income. Think of it like a profit and loss sheet, but for a property. The net operating income, NOI, this is how you can determine what the value is and what you're getting. And then the loan to value. So when you go to refinance, this is typically lender terminology of what they're going to look at the house's value is, and then what the loan amount compared to it is. So why buy and hold? Well, it's a great question. I might have scared you off, and if you're still watching this video, let me be clear, I'm not anti-buy and hold. I used to have a portfolio of properties, mostly single-family homes. I bought them right. They appreciated over time. I didn't trust the market that we're currently in, so I offloaded a bunch of my single family. I've only got a couple single family rentals left that are in phenomenal locations, and now most of the assets that we buy and hold or own long-term are commercial buildings. From there, again, our goal and why you should buy and hold as well is to build long-term wealth instead of relying on one-time profits. Fixing and flipping is active income. Wholesaling is active income. Buying and holding, in all technicality, is passive. So the passive income that you're making is not required for you to do anything other than maintain the property. You can generate monthly cash flow while your investment grows. So typically as the mortgage and the payoff is going down, the appreciation and the value of the home typically is going up. The benefit from the appreciation, the loan pay down, and the tax advantages are usually the number one reason why people do this. And then you could obviously, if you do this right, create financial freedom through recurring passive income. One great rental property can produce income for decades. I mean, we see this time and time again. Every time someone talks about buying a rental, I will tell you, as long as it's in a good location, it's a good price, the cash flow numbers make sense, and you're comfortable with it, it's an asset and it makes sense. And with that said, your long-term wealth is determined by the deal you buy, aka the acquisition. I'm going to keep repeating that throughout this presentation today because that's how important it is. And there are a lot of ways you could buy and hold. You could do this through creative finance. You could do this through seller finance where there is no mortgage. You could do this through DSCR where you get a lender that looks at it as an asset rather than a qualification on your end. You could do this through conventional FHA, VA. You obviously want to make sure to consult a financial advisor, a mortgage lender or broker, and then also a real estate agent or advisor that could give you some feedback. Once you have all of that in consideration and you're comfortable with the numbers, congrats, that's how you buy real estate rentals. Now I have 2 quotes here. I know in the past couple of presentations I've just had one, but I think that this was such an important conversation and topic today that I had 2. The goal isn't to get rich overnight, it's to build wealth over time. Rome wasn't built in a day in this case, meaning you have to be willing to play the long game in buying and holding. I've never seen someone buy and hold a property less than 6 months. If we could just speak freely here, that's called a fix and flip. So buy and hold is pretty self-explanatory. You are holding the property for what is to be assumed long-term. The goal isn't to chase or bet on appreciation. I'm going to say that one more time. The goal isn't to chase or bet on appreciation, meaning if you're buying a house saying, but Disneyland's coming, you're an idiot. Don't buy that house. The goal is to buy properties that make sense on day one. You're buying properties that are an asset that you need to have no emotion in, and you need to be purchasing this based on your skill set, your deal, and how good it is, and what your comfort is to be able to actually go and cash flow, not to bet on appreciation. So the skills that you're building are deal analysis, portfolio and people management, and then also identifying great acquisitions, which then compounds with every property you buy. The more you do it, the more comfortable you get. Please just don't get addicted to buying a bunch of rental properties if you don't have the means to. This is something that I feel like a lot of people come into this industry, they do it out of order. They try to jump right into buying rentals because they want to be financially free and they don't have much money to do so. If anyone on the internet told you that you could get into buying and holding real estate and you could do this with $0 down, zero credit, zero experience, they're probably trying to sell you a course. Okay. I mean that with all respect. Of course, there's ways you could do it, but do I think a brand new investor should be starting at this point? Absolutely not. I think that is the dumbest thing that you could start with. That is the easiest way to lose all of your money. And I do not encourage that for anybody that is just getting started in real estate investing. Pick up the phone, get out a notepad, use a couple calculators, and learn how to do acquisitions by starting with wholesaling. And if you have experience, fixing and flipping is also a good starting point. So the buy and hold process is the same as fixing and flipping with just a couple changes. We are going to find a profitable deal. I don't care how you do it. I like the MLS. I like agents that I work with, but you could also do this from wholesalers or direct to seller if you have the means to. You're going to analyze the numbers, ARV, rehab, holding costs, anything at all that's going to help you get to the maximum allowable offer, obviously considering return on investment and what you are looking for. We're going to purchase the property. There's a few extra ways you could do this one. Cash, conventional, DSCR, hard money and refinance. You could do seller finance. There's a few other ways not mentioned, but there's a lot of ways here you could go and do this, but you need to purchase the property. Obviously, this goes into your name. Consult a CPA, attorney, accountant, whoever, and put it into a trust or an LLC if that's what you would like to do. Just please make sure not to put it in your personal name. After that, you are going to renovate strategically. If needed, if needed, please do not renovate a house that doesn't need it. No emotion. I've seen a lot of people buy rental properties that think they're making the Taj Mahal and they're going to have all this deferred maintenance. And then after 6 months, the tenant's out when you expected it to be a year. That house that you just put all this time, effort, money, and emotion into, somebody else treated like crap. People put oil down the freaking oil and grease down the drain. People don't take care of the property because it's not theirs. That's why it's so important to screen out qualified tenants or hire a property manager and really just remember to take the emotion out of it. After that, I kind of went through 5 there as well. Hold the property long-term and build wealth. This is cash flow and appreciation that helps you build wealth long-term. And then again, you have the loan pay down and tax benefit immediately. You don't need to do the tax benefit tomorrow. This is something you could do a year from now, 2 years from now, 5 years from now. Consult with your CPAs on when the best strategy and time is to do so, but usually you're accelerating the depreciation in the property. So imagine all the maintenance and deferred things that you typically deal with down the road. You're essentially assuming the tax ability to write off immediately, which is what lowers your tax bill now. That's one thing that most people don't realize about buying and holding. It's not just about the monthly cash flow. In fact, when people tell me they're buying and holding to create financial freedom and to buy a whole portfolio and own X amount of doors, that's typically when I know I'm talking to a newer investor or someone that doesn't fully understand the benefit of buy and hold. The tax benefit and the long-term appreciation, the loan being paid down while building that wealth, is really the benefit to buy and hold. Common mistakes, there really is only one, honestly. It's this one right here, overpaying for the property. This is the number one reason buy and hold investors struggle. They buy a property betting on appreciation. They buy it betting on cash flow being higher than it is. There's resources out there like rentometer.com, the MLS, Zillow, anything where you could see the actual properties that got leased out. You could see the price that it went and it's being rented for. So when you can actually comp and analyze the property confidently and you're buying a property that has equity in it, that's when you know you're buying a good deal that you're comfortable with. Other common mistakes, not as detrimental to the first one, but buying a property that doesn't cash flow. I don't know why somebody would do that. Like if you're buying a property that doesn't cash flow, short-term rentals usually, right? Airbnb, no shade. It's just what I see. I'm sorry. Don't shoot the messenger. People that are saying, well, if you take this house and you actually rents it out for 36 days a month with 115% occupancy, I can actually make money on this deal. Or what if I take this 2 or 3 bedroom house and I make it 17 bedrooms? It cash flows. That's not a strategy that I would bet on. That's not one that I would end up going to start. That is typically for experienced investors or for people that got caught into a pickle to be able to get out of a transaction without losing money. Underestimating maintenance, vacancies, CapEx, anything at all that could go wrong, you're not assuming. If you could just take words of advice from me, if you're flipping, assume 5 to 10,000 is going to be extra in your budget. And if you're buying and holding, assume occupancy is not going to be 100%. Assume maintenance of things is going to go wrong. So if you do not have a rainy day fund, you will get caught with your pants down. Next biggest mistake I see is waiting for the perfect market instead of just buying great deals. I have friends that have bought rentals every year that I have been in this business. For the past 10 plus years, I've seen people come in, I've seen them buy rentals in economies where interest rates are high, prices are high, competition's high, everything is ridiculous in what the general public would say. And these are people that make a lot of money, offset their taxes, and they cash flow on great properties in great locations. So waiting for the perfect market, it just doesn't exist. You need to be comfortable and confident, ideally experienced, and making money to be able to go and do this, and you can actually go and do it confidently. The next mistake is thinking you need dozens of rentals to build wealth. We've got a couple of rental properties I told you we're keeping that bring in a good amount of cash flow every single month. I've seen people buy deals that bring in $10,000, $15,000, $20,000 cash flow off of one property. You don't need some massive portfolio. Whoever it is that's chirping in your ear or whoever you're following on social media that's saying to do that, is probably not your friend. That's somebody that's trying to have some sort of a measuring contest, if you pick up what I'm saying, and they want to encourage you to go and do something, which is either buying a course from them or they're trying to teach you how to do something that is not in your best interest. I don't think you need a massive portfolio to make a lot of money. I think you need to create enough active income through acquisitions, offset taxes with real estate rentals and buying and holding, and then over time you will find there is a comfortable ground for you to be on, which is somewhere between, in my head, 1 to 5 on the low side, 5 to 10 on the high side. Anything above 10 rental properties, with the exception of you making a lot of active income, is really excessive, and I would question how much money you're making per deal. I mean this with all respect. I should probably put a huge disclaimer like, these are Ryan's opinions. I apologize if I offend you. This is not financial advice, and I wish you the best. Can you tell I'm not really a big fan of buy and hold? Buying and holding real estate, depending on the economy and the market, might make a different opinion for sure, but I have offloaded most of my real estate rentals as I do not personally believe that is the easiest way to create wealth. I have saved a lot of money on taxes, and that is the reason I will continue to do this strategy, but the reality is I am better at acquisitions than I am at passive income. The passive income that I make that is a lot greater than buy and hold is in other investments, some as a lender and some outside of real estate in other companies that have made me a lot of money. But let it not be fooled here. I am the guy that is better at acquisitions, and I will stand on that mountain and I will tell everybody about it. I am the guy that could help you learn how to find these deals. I find them in ways where we don't spend money on marketing, specifically on the MLS and through real estate agents and strategic joint ventures. After that, you could go and do whatever you'd like. You could go and buy and hold. You could buy fix and flips. You could go do creative finance or whatever else you would like in the business. But I want to make sure it's clear. My opinion is that you need to get better at acquisitions to create higher active income. So I appreciate all of you guys making it to this far in this series and watching the videos. Hopefully you get some value. If you disagree, throw it in the comments. I still love you and I respect your opinion. These are all based off of my opinions and experience of being in this industry for a while. If you're trying to get started in real estate investing, I have a real estate investing school, which will be right along here. The real estate investing school we created to help teach people the basics. That way you don't need to start in some big expensive course or community. You don't need to go and spend all of your life savings attempting to learn something from the start. You could get in the room, learn from people that are actively doing it, build some relationships, and have a very strong foundation. Hopefully you guys got some value in today's episode. I appreciate you again, and I'll see you on the next one.